Tax collectors were some of the most despised people in ancient history, bribed, threatened, sometimes killed. And yet the systems they were forced to build to survive their own corruption became the ancestors of the fraud detection AI, protecting your bank account today. The people everyone hated accidentally invented one of the smartest tools we still use. This is the strange, hidden lineage between ancient tax fraud and modern machine learning, and why the connection isn't a coincidence. Every large civilization has faced the same quiet crisis. Someone has to collect resources from people they cannot personally watch. A farmer reports his harvest. A merchant reports his goods. A citizen reports his income. And in every case, the person reporting has a reason to shrink the truth. This is not a story about dishonesty. It is a story about distance. The state cannot stand in every field during harvest. A bank cannot watch every card swipe. A platform cannot observe every transaction as it happens. So each of them faces the same question. How do you know if someone is telling the truth when you were not there to see it? This gap between what people report and what actually happened is called information asymmetry. One side knows the truth. The other side has to make decisions without it. And solving that gap turns out to be one of the oldest problems in organized society. It mattered thousands of years ago because early states could not fund armies, temples, or public projects without reliably collecting resources from people they had no way to supervise. It matters just as much today in fraud detection, insurance, credit, and banking. The tools have changed completely. The underlying problem has not moved an inch. So how did ancient administrators solve a problem they had no technology to solve directly? They stopped trying to verify people. Instead, they built systems that verified records against other records. In ancient Mesopotamia, some of the earliest known writing was not literature or law. It was accounting. Scribes in cities like Uruk recorded grain deliveries, livestock counts, and temple transactions on clay tablets. These records were not just written down once and trusted. They were cross-checked against other tablets, other officials, and other stages of the same transaction. If a shipment of grain was recorded leaving one storehouse, a matching record was expected to show it arriving somewhere else. A mismatch was a signal. It meant something needed to be investigated. This is worth sitting with for a moment. Writing itself, one of the most important inventions in human history, developed largely as a tool for verification, not storytelling. Bookkeeping. Ancient Egypt took a similar approach in a different form. Tax assessments on farmland were not based purely on what a farmer chose to report. Officials used tools like the Nilometer, a structure built along the Nile to measure the height of the annual flood. Flood height was directly related to how fertile the coming harvest would be. So the state had an independent estimate of expected yield, separate from anything the farmer said. If a farmer's reported harvest looked suspiciously low compared to what the flood levels predicted, that gap invited scrutiny. Notice the shared mechanism here. In both Mesopotamia and Egypt, the authorities were not relying on trust in any individual person. They were relying on a second, independent source of information that could be compared against the first. One record checked another. Rome pushed this idea into a different structure entirely. Rather than employing government tax collectors directly, the Roman Republic often auctioned off the right to collect taxes in a given province to private contractors known as Publicani. These groups paid the state a fixed sum up front, then collected taxes from the population to earn a profit. It was a system riddled with its own abuses, and history remembers many Publicani as ruthless. But built into this structure was another layer of oversight. Publicani operated in groups, often organized as companies with shared financial stakes, which meant partners had an incentive to monitor each other. The state also retained the power to investigate and prosecute abuses, at least in principle, creating a rough system of checks layered on top of self-interest. None of these ancient systems were fair by modern standards. Punishments could be harsh, and errors could ruin lives. But structurally, they were solving the exact same problem administrators face today. They could not trust the individual, so they built architecture around the individual. A second data source, a comparison point, a way to catch a gap between claim and reality without needing to watch every person all the time. That single idea, checking one record against another, did not disappear when these empires fell. It simply waited for a faster machine to run on. Fast forward to today, and the scale of the problem has exploded. Banks process millions of transactions an hour. Tax authorities handle hundreds of millions of returns a year. No human bureaucracy, no matter how well organized, could manually cross-check records at this volume the way a Mesopotamian scribe once did. So the solution had to evolve. But notice what it evolved into. Modern fraud detection still runs on the same core idea ancient administrators used. Compare a claim against an independent expectation and look for the gap. One striking example is Benford's law, a mathematical pattern used by forensic accountants and auditors, including at agencies like the IRS. In large sets of naturally occurring numbers, such as real financial transactions, the first digit is not evenly distributed between 1 and 9. Lower digits, especially 1, appear far more often than higher ones. This pattern shows up consistently across real-world financial data. When people fabricate numbers, they tend to distribute digits more evenly, because that feels more random to a human mind. As a result, fabricated financial records often deviate from the expected distribution in ways that are statistically detectable. It will not catch every fraud, but it gives investigators a starting signal, a modern echo of the flood-level comparison in ancient Egypt. An expected pattern, checked against an actual one. Banks and payment networks extend this same logic using statistical baselines. Every account develops a kind of behavioral fingerprint, built from typical spending amounts, common locations, usual times of activity, and typical types of purchases. When a transaction falls far outside that established pattern, it gets flagged for review or temporarily blocked. This is not the system reading minds. It is the system comparing a new claim, in this case a transaction, against an independent model of what normal behavior looks like for that account. Machine learning pushes this further by finding patterns across far more variables than a human analyst could track at once. Instead of comparing a transaction against just one baseline, these models can weigh dozens or even hundreds of factors simultaneously, learning from millions of past transactions what fraudulent activity tends to look like across an entire population, not just one account. The scale is staggering compared to a clay tablet, but the underlying structure has not changed. There is still a claim. There is still an independent point of comparison. There is still a decision made based on the size of the gap between them. What has changed is speed and reach. An ancient audit might take weeks or months and could only ever cover a small area. A modern fraud model can evaluate a transaction in a fraction of a second and apply the same logic across an entire country's banking system at once. The tool became exponentially faster and more far-reaching. But the underlying idea driving it is not new. It is a 4,000-year-old idea about verification, now running on infrastructure ancient scribes could never have imagined. Strip both systems down to their bare mechanics, and a clear structure appears underneath all the historical detail. Every verification system, whether it runs on clay tablets or code, is built from the same 4 parts. First, a reporter who has some incentive to shade the truth. Second, an independent source of information that exists separately from that reporter's claim. Third, a method of comparing the two. And fourth, a consequence when they do not match. In ancient Egypt, the farmer was the reporter, the Nilometer reading was the independent source, the tax official's comparison was the method, and a tax adjustment or investigation was the consequence. In a modern bank, the account holder's transaction is the reporter's claim, the behavioral baseline is the independent source, the algorithm is the method of comparison, and a flagged or blocked transaction is the consequence. Different centuries, different tools, identical skeleton. This is not a coincidence, and it is not because modern engineers studied Mesopotamian tablets. It happens because the underlying problem, information asymmetry at scale, only has a limited number of real solutions. Any system trying to manage resources among strangers, at scale, keeps getting pushed toward the same structural answer because most other approaches simply fail once the population gets large enough. The similarities go beyond structure. Both ancient and modern systems rely on independent corroboration rather than personal trust. No scribe was trusted simply because he seemed honest, and no modern algorithm trusts a transaction simply because the account holder claims it is legitimate. Both systems also use deviation from an expected pattern as the trigger for scrutiny, whether that is a harvest number that looks too low compared to flood levels, or a transaction that looks too unusual compared to normal spending. and both had to wrestle with the cost of false accusations. In ancient states, wrongly punishing an honest taxpayer could fuel resentment and unrest. In modern systems, wrongly freezing someone's account damages trust in the institution and can carry real legal consequences. In both eras, accuracy was never optional. It was a requirement for the system to keep functioning at all. But the differences are just as revealing, and forcing them into a perfect match would distort the truth. The most obvious difference is speed and scale. Ancient verification was slow, local, and heavily dependent on individual officials, while modern detection is automated, global, and can respond in real time. There is also a deeper difference in what counts as evidence. Ancient systems relied on physical, human witness data, a flood measurement, a countable grain shipment, a signed seal. Modern systems increasingly rely on statistical inference across enormous datasets, which is a fundamentally different kind of evidence. It is not a direct physical fact. It is a probability drawn from patterns in data most people will never see. That shift also changes how understandable each system is to the person being judged. An ancient farmer accused of underreporting his harvest could, in principle, see the flood measurements and understand the reasoning behind the accusation, however harsh the punishment might be. A modern user flagged by a fraud algorithm often has no idea which of the dozens of factors triggered the flag. The modern system may be faster and statistically more accurate, but it is often far less transparent to the individual caught inside it. Zoom out across both eras, and a single pattern connects all of it. Trust does not scale, but verification does. Personal trust works fine between a handful of people who know each other. It collapses almost immediately once a system involves thousands or millions of strangers. Every civilization that grew large enough eventually ran into this same wall, and every one of them, independently, reached for some version of the same solution. Build a second source of truth. Compare it against the first. Let the size of the gap decide what happens next. That is the real lesson sitting underneath 4,000 years of tax collectors, scribes, auditors, and algorithms. Any system built to operate at scale between people who do not know each other cannot depend on individual honesty to hold it together. It has to be built so that the truth is structurally easier to detect than a lie. The tools that accomplish this will keep changing, from clay tablets to nilometers to statistical models running in a data center. But the principle driving all of them traces back to some of the least trusted people in the ancient world, who were forced, out of necessity, to build the very logic that quietly protects trust in modern life today. So here's a question worth sitting with. Where in your own life or work are you still trusting people, when you could be verifying systems instead? Drop your answer below. I read every one.